One of the best performing stocks over the last 10 years in the S&P 500. We're taking a look at Intuit Incorporated, ticker symbol INTU today. We'll jump into their first quarter results, guidance, and take a look at the financials. As always, we'll also dive into their technical analysis, and this one is a fairly predictable and stable stock. You can probably guess where this one is headed over the next few quarters. As always, if you're new to the channel and find this type of content valuable, be sure to hit that like and subscribe button below. It would mean a lot. First time taking a look at Intuit Incorporated on the channel. If you have held Intuit for really any extended period of time, you've probably made a killing in the market. This one has returned you just 650% over the past 10 years. I think its annualized rate of return is over 20% over the past 10 years, and that is just phenomenal. Its market cap over $157 billion, does pay a small dividend. We'll talk more about that. The one thing with Intuit that has always held me away from this stock is probably just the valuation. This one is still trading at over a 34 times on a forward earnings, and then I have a 5-year price to sales picked up for Intuit. This one is trading at over 11 times price to sales. I also have Microsoft's price to sales picked up, and surprisingly, Microsoft is trading at 13 times a price to sales. That is just honestly hard to wrap my head around. But the fact that both these companies have similar gross margins at north of 70%, yeah, they make a ton of that revenue flow straight down to their bottom line. And I think Intuit's net margins are closer to 16%, and then Microsoft has a bit higher net margins. But I think, in my opinion, these valuations are getting a bit stretched for honestly both of these companies. Specifically for Intuit, I think if you can pick this one up closer to a really 8 or 9 times price to sales, I think there you can probably get a pretty good valuation on this one. Their first quarter results came out. Revenues came in at $3 billion. That was up 15% year over year. That did beat expectations over on Wall Street, which were closer to $2.88 billion. So roughly a $120 million beat. On that top line, you see their business segments, small business and self-employed group. Revenues were up 18% on a year over year basis. The consumer group also grew revenues at 25%, and Pro Tax group grew revenues at 24%. The interesting note to see is Credit Karma revenues actually declined 5%. So if you didn't know, Intuit is the platform behind TurboTax, Credit Karma, QuickBooks, and MailChimp. And so all these products are wrapped under Intuit. And so Credit Karma revenues actually came down 5%. We come down, see that the decline in Credit Karma revenues in the quarter was driven primarily by headwinds in personal loans, auto insurance, home loans, and auto loans, partially offset by growth in credit cards. And so this is interesting to see. This is higher interest rates for home and auto directly affecting a business segment over at Intuit, that being Credit Karma. And likely as interest rates continue to stay elevated and possibly even go a bit higher, that will continue to put pressure on revenues over at this segment at Intuit. And consider the fact that this is a rather large business unit over at Intuit, makes up roughly 15% of their total revenues. And so that being down 5%, yeah, that is actually a significant hit over at Intuit. Pretend if this was up possibly 10-15%, if interest rates were at, not such an elevated level, possibly total revenues could be up closer to 20, maybe even 25% over at Intuit. So this certainly does matter. Now on a share repurchase, they did roughly purchase close to $600 million worth of their common stock in this most quarter. They also have roughly a $3.2 billion share repurchase program still remaining. Keep in mind, this is a company at nearly a $160 billion market cap. And so $3 billion not really moving the needle over at Intuit, but it is a nice thing to see that they are repurchasing shares. They also declared a 90-cent per share dividend, and that represents a 15% increase on a year-over-year basis. So you're likely also holding Intuit for its dividend growth. You come down and see their 5-year dividend growth rate on a compounded basis has been close to 15%, and they've seen that for over 12 years. So this is a company that, while they're paying currently a rather small dividend on a forward basis at just 0.64%, you are experiencing very good dividend growth. And they still have only a payout ratio of close to 21%, so they do have room to increase that dividend for the foreseeable future. Their earnings are expected to also grow in line at roughly 13 in that mid-teens percentage over the next 3 years, and so they certainly have room to continue to grow that dividend over at Intuit. In terms of forward guidance, everything looks roughly in line to what they just expected in this most recent quarter. So revenues are expected to be in that roughly $16 billion range for the full year 2024. That would represent close to 11 to 12% growth on a non-GAAP EPS basis, that is expected to grow also roughly in line at the midpoint of 13%. They also reiterated their full year fiscal 2024 segment revenue guidance. And again, they're seeing Credit Karma declining 3% to a growth of 3%. So roughly flat revenues on that Credit Karma side year over year for the full year. And again, I guess they're expecting the Fed to maybe not increase rates higher, but at least keep them at an elevated level for the next, we'll call it 3 quarters. And so they do expect Credit Karma revenues to be roughly flat on a year over year basis. They do expect all other business segments to grow, with the small business growing at roughly 16%. So that is very strong on a year over year basis. For this next quarter, they do also expect revenues to grow roughly in line at 10 to 12%. Walking through this income statement, frankly, looks phenomenal. We have that $3 billion worth of net revenues. That is up 15%. Last year, we were at closer to $2.6 billion. Our cost of revenues are very small over at Intuit. And so we have roughly 70% gross margins. You add these cost of revenues up, that is roughly $750 million. Last year, we were closer to $650 million. So not a huge jump on those cost of revenues. And we drove closer to $300 to $400 million of additional top line revenue. In terms of their sales and marketing, that actually declined by roughly $30 million. Last year, we were closer to $800 million. Now we're closer to $770. R&D ticking up just a little bit. You see G&A actually ticking up a decent amount, over 10%. Last year, we were at $300 million on G&A spend. Now we are closer to $342 million. So that is still growing at a decent clip over at Intuit. All things considered, total costs coming in at $2.67 billion. We subtract that off of our total revenues of nearly $3 billion. We get to operating incomes of $300 million. Last year, we were at just $76 million. So very strong operating income growth. Intuit doing a good job controlling costs really where they can. And that top line growth of 15% really flowing all the way down. On the net income side, posting net incomes of $240 million last year. Again, you see we were at just $40 million. And so cost cutting and revenue growth really flowing through over at Intuit. This is a fantastic quarter. The question is, can the growth continue over at Intuit? This mid double digit growth, will that continue over the foreseeable future? And really, does that demand such a high multiple? You see on a 2026 basis, this is trading at 26 times a forward price to earnings, and just on a next year basis, trading over 30 times a forward price to earnings. So the valuation over at Intuit still looking pretty hefty. The balance sheet over at Intuit looking healthy. They are sitting on more assets than liabilities. The interesting line to note is their cash and cash equivalents. So that ticked down by roughly $1 billion. And the interesting thing to see is that the amounts held for customers actually ticked up by close to $2 billion. So last year we were at just $420 million. Now we're close to $2.5 billion in the amounts held for customers. And that is because the funds and the amounts due to customers increased basically the same amount. And so now they are owing more to customers, close to $2.5 billion. They have to put aside more money for those customers. And so they took away close to $1 billion from cash to really put that aside for that line. All things considered, though, they are sitting on close to $6.2 billion worth of current assets, just $5 billion in current liabilities, and total assets coming in at over $28 billion. And then total liabilities at over $11 billion. So a current ratio over 1 and asset to liabilities ratio greater than 2. In terms of cash flows, they pull down that $240 million net income line. Last year, we were just at $40 million. We get to add back some line items. And from an operating cash flows, we actually lost close to $100 million in this quarter. Same time last year, we were sitting at a operating cash flow positive of close to $330 million. The big difference is really in the income taxes payable. I'm frankly not sure why this line item is close to $560 million, considering their net income is just at $240 million. I'm just not sure why Intuit has such a large income taxes payable line in this quarter. Likely, I'm hoping is a one-off thing. Let me know in the comments section below if you really understand what's going on with these income taxes payable. But nonetheless, we bring down that operating cash flows. And really, they refinanced some long-term debt, close to $4 billion. They paid out some dividends and brought back close to $580 million worth of common stock. That actually did accelerate from same time last year. We were closer to $510 million in share repurchases. So Intuit continuing to buy back shares. Again, it's a small amount, but it is a share repurchase nonetheless. Moving on to the technicals, this one has been channeling upwards really over the past 1 year in a fairly predictable range. Right now trading closer to the higher end of that range, really hit its head back in the second week of November, closer to $570 a share. I think it's more likely to come back and retest, maybe not these lows here, but at least the middle end of this channel, closer to $530, $520 a share. I think jumping into this stock at these elevated levels, in my opinion, doesn't make a whole lot of sense. You do have a decent amount of downside and not a ton of upside, considering the upper end of this channel is basically right where the stock is at. In my opinion, I think if you can come in here, pick up shares of Intuit closer to $476, maybe in $480 a share, that in my opinion would make a whole lot of sense. Sub 500 is where the valuation on this stock would, in my opinion, make a lot of sense. That would be a decline close to 15%. That would also mean the price to sales would again come back underneath 10, maybe closer to a 9 times price to sales, where trades more in line is more attractive on a long-term risk reward basis. Again, this is a stock that has performed fantastically really over the last 10 years. It did see a big decline similar to a lot of tech stocks back in 2022, but I don't doubt for a minute that this stock will continue to chug along in this sort of channel, maybe post candles above and below these ranges every so often, but again, not for a long time. And really any time I think you can come pick up Intuit on any major declines, that can be a good long-term buy and hold. This is a stock that trades fairly expensive and has been for a long time, but deservedly so. Makes extremely strong gross margins. You get that dividend growth, and likely as the interest rate environment eases up, yeah, this stock will continue to see benefit from its credit side, again, gaining momentum. That was my take on Intuit Incorporated. Let me know your thoughts on this one in the comments section below. As always, thanks so much for listening, and I'll catch you guys in the next video.